So personal finance is managing, protecting, and growing your money. Now, what is financial planning? Basically, planning your personal finance is called financial planning. Simple, right? But not easy. See, it's like health. Just like we know that we need to eat well and exercise more, but we don't do it. We need motivation, we need guidance, and sometimes when we get it wrong, we need correction. So a yoga instructor and a professional, and then maybe a doctor as well. Similarly, in finance, while we may know that we need to save more and invest more, we don't actually do it. So we need the help of financial planners or financial advisors to help us with motivation, with guidance, and also correcting any mistakes we make. So in this episode, we will talk about what is involved in financial planning, the different types of financial planners, and also what a good financial plan looks like. Hi, I'm Hansi, and in this series, we're learning to be money mindful. Let's get started. So let's start with the logistics of financial planning. We need to do our homework before we see anyone. We need to make a list of all our assets and liabilities. We need to make a list of our family members and any other dependents that we have to provide for. Then we have to make a list of our goals, because that's what a financial advisor will need to know. All of this is collated in one place. And if you don't have all the paperwork with you, they can actually work with your other providers like a chartered accountant or a lawyer and so on. But ideally, you should collate all that in one place. With that, you go to a financial advisor or planner, or you fill it in online, and then they start sort of collating it. They may give you a risk profiling questionnaire, which basically assesses on how you react to market volatility, or whether you panic or whether you stay calm. We will discuss that in much more detail in another episode. But for now, let's just assume that they are right. Then they will give you a financial plan which has recommendations or suggested actions. We go through it, we decide whether it in fact captures our details correctly and we are comfortable with it. If not, we can tweak it, we can give them feedback. Then there's a final plan, and that's what gets executed. It doesn't stop there. You do have to do an annual review because things change. Markets change, we change, our circumstances change, everything changes. So we have to keep doing this annually. So that's the logistics. Now let's look at different types of financial advisors. So in health, we have generalists and specialists, right? Similarly, in finance, we also have generalists who are called financial planners or financial advisors. And then we have specialists who specialize in investments. They're called investment advisors. But don't take these terms very seriously. In reality, people tend to call themselves by all kinds of names. So you have to check. So a financial planner is supposed to cover all aspects of your personal finance, right from protecting, from investments, insurance, wills, legacy, and everything. Similarly, your investment advisor is supposed to help you with all your investments. But in reality, they might not have the training or the inclination to cover all investments. So, for example, investment advisors could be your stockbroker. The stockbroker only deals with stocks, as the name suggests. Similarly, there are bond brokers or bond platforms that only deal with bonds. Similarly, there are also mutual fund distributors who tend only to deal with mutual funds. They are not supposed to and don't give usually advice on stocks or bonds. Then, technically, your jeweler gives you gold advice, unsolicited, but tends to. There's real estate brokers who tell you that real estate is the best investment. You get the idea. And then there are other ancillary advisors like your lawyers and chartered accountants who are not financial advisors, but sometimes cross over to give you financial advice. So you have to understand what their qualifications and their sort of service areas are. Now, this classification is based on what they cover. There's another important way to classify advisors, and that's based on how they get paid. So there are two ways they can get paid. Either they take a commission or they take a fee from you. If they take a commission from the product provider, they are technically acting as agents of that product provider, even though they say that they represent many, which is basically what a broker does. But understand that their interests are to transact more. If they take a fee, their allegiance is to you. In fact, they're called a fiduciary. They're supposed to put your interests ahead of their own. Now, a business model does not mean that they are good or bad financial advisors. It's just that incentives drive behavior. So you need to understand what the incentives are. So now let's look at what a financial plan is supposed to cover. So a good financial plan should start with a confirmation of their understanding of your situation. So it's supposed to have a one-page summary about who you are, what you do, what you earn, who your dependents are, all your assets and liabilities, and so on. Then it should list all your goals in terms of what you want to achieve, when you want to achieve it, and also how important they are to you. So classifying them by needs, wants, and desires. A good financial plan will calculate the value of your goals. So they will project out in the future. So for example, your retirement, how much you're likely to spend in your retirement, and then they calculate backwards and figure out what you need today. Same thing with your children's education, same thing with your house, same thing with vacations. So these are broadly the goals that most people have, but any goal that you give them, they're supposed to help you calculate how much those goals will cost. Then remember we mentioned the risk profiler? Some advisors use a psychometric tool to assess your risk tolerance, which is basically how you react. Other advisors might just simply ask you how you reacted in the past and how you are likely to react yourself. So your own assessment. After they've taken stock of everything, they will give you a recommended course of action. So basically what you're supposed to do, whether it's to do with your insurance, with your investments, whether you need to save more, whether you need to restructure your situation, anything that will help you reach your goals better. And then a good financial plan will list all the assumptions they've made in their document. So for example, what have they assumed as your income growth assumption? So how often you get your salary increases and by how much? Similarly, they might break inflation up into health inflation, education inflation, because these tend to be higher than general inflation. They will also list the return assumptions they've used to assume how much your portfolio will grow. And then you can check whether all these assumptions are reasonable or not. Now, that's a lot of information that a plan covers. So it can run into 20, 30 pages, but it doesn't need to be. In fact, a good financial plan can also be in one page, just as a drawing, as a mind map, or something like that. If it is in fact long, it should have a good summary in simple English that you can understand. Now let me point out this one key aspect in which plans differ. And that's how they project how much money you need in the future. The traditional way is to lay out all your goals on a timeline and sort of make assumptions on how much they cost in the future and what they will cost in today's currency. So basically they tell you one number, which is the gap between where you need to get to and where you are. Now there's a newer way to do this, which is called goal-based wealth management. And in this, instead of putting everything on one timeline, they list all your goals and then they put the assets against the goals. So you can see very visually which goals you're likely to meet and which ones will fall short. Either of these two methods involve a discussion of trade-offs, which is basically you need to give up your goals or you need to save more, invest more, and so on. There is a third and simpler method which is used by the online bloggers and calculators, which is simply using a rule of thumb, which is called a heuristic. in terms of how much you might need. So we make a list of all your goals. There might be 3 different variations of it, so needs, wants, desires. And then we multiply that by a factor. It could be anywhere between 25 and 40. Say take somewhere in the middle, which is 30, that you can live on, say, 12 lakhs per annum in retirement. You multiply that by that factor and you calculate how much money you need. If invested well, that will be able to help you retire right now. So there are 3 ways that I've given you that most financial plans approach the calculation. But there may be more methods, so you need to ask them how they've done that and discuss whether you feel comfortable with that process. So, in summary, we have discussed the logistics of financial planning, we've discussed the types of financial advisors, and we've discussed what a financial plan is supposed to include. And I've also pointed out what you need to be mindful about. You need to be mindful that you have to do the homework. You need to be mindful that different financial advisors cover different things and, more importantly, get paid differently. And you need to be mindful that a good financial plan will have a bunch of assumptions and different approaches that you need to be comfortable with. So I hope we've learned to be more money mindful. See you in the next episode.